What if I told you the world's richest investor quietly fears a collapse? Right now, stocks are at record highs, Nvidia alone worth more than every US and Canadian bank combined. But behind this boom, Buffett sees four red lights blinking. And if he's right, the biggest market crash since 2008 might already be loading. Stay with me, because in the next 5 minutes, you'll understand what Buffett knows that others ignore. Since 1965, Warren Buffett's Berkshire Hathaway has returned 20% a year, twice the S&P 500. Yet today, even he admits, anything can happen in the markets. Investors are buying stocks with borrowed money at historic levels. Debt is fueling the illusion of growth, but it's not real. The VIX, the fear index, just spiked over 30%. Volatility is rising. Confidence is cracking. Buffett warned decades ago, never borrow to invest. But right now, that's exactly what millions are doing. The first red flag, the debt trap. Look at the charts. The amount of shares bought on margin debt has exploded over 30 years. That means much of today's market value exists only on borrowed dollars. When debt rises faster than real value, history repeats. 2008 didn't start with panic. It started with leverage. Buffett's first rule: buy a company, not a stock. If you're chasing quick profits, not understanding the business, you're gambling, not investing. The second red flag: concentration risk. Right now, 10 tech giants, Apple, Amazon, Nvidia, Microsoft, control a third of the S&P 500's weight. Just 10 companies steering the entire economy. That's more concentrated than during the dot-com bubble. If any of these giants stumble, they could drag 490 others down with them. The market's average valuation, its PE ratio, is over 30. Historically, it's 16 to 20. To return to normal, prices would have to fall 50%. Buffett reminds us, new technology always excites the crowd, but only a few survive. In 1900, 2,000 car companies raced for the future. 3 survived. Sound familiar? The third red flag, the Buffett indicator, flashes red. Take the total value of all US stocks and divide it by GDP. That's Buffett's favorite indicator. Right now, it's 69% above historical norms, the highest deviation in decades. Every time it's looked like this, a correction followed. Buffett's third rule: always leave a margin of safety. Don't drive a 10,000-pound truck over a bridge built for 10,000 pounds. The market right now? It's that bridge, and we're adding weight every day. The fourth red flag, the activity illusion. Retail traders, everyday investors, are rushing into day trading options and risky swings. 90% will lose money. Buffett's fourth rule: do less. Think longer. He once said, if you had a punch card with 20 holes and could buy only 20 stocks in your life, you'd choose wisely. The best investors, according to Fidelity, were the ones who forgot their accounts. Or were dead. Because the real secret isn't timing the market, it's staying alive long enough to let time work for you. Buffett's not predicting doom. He's reminding us that panic creates opportunity, but only for those still standing when the smoke clears. So, before you buy the next hyped stock, ask yourself, would Buffett?